Welcome to vTalkInsight, Market Drivers Daily for June 29th, 2026, where the AI Capex boom, Middle East energy risks, and resilient growth are pulling asset prices in different directions. The key question now is how long the AI infrastructure build-out can offset geopolitical and inflation headwinds before valuations, financing costs, and policy frictions force a broader repricing. The core story today remains AI. But the tone is shifting from simple optimism to a more complex Capex and financing cycle. South Korea is at the center of this, with Samsung and SK Hynix planning investments approaching $900 billion in chips and data centers, backed by government support that amounts to several % of national output. These plans include multiple new memory fabs and a national push to double drone production within 5 years, as Korea aims to keep its lead in AI critical memory. At the same time, Korea is targeting roughly $650 billion for AI data centers by the mid-2030s, while AI infrastructure suppliers globally are pouring billions into chips, robotics, and power-hungry server farms. This investment wave underpins the earnings story that has driven recent equity upgrades, with AI-linked companies expected to grow profits several times faster than the broader S&P, and some analysts talking about index levels near 8,000. Early data shows AI-related sales in data centers already outpacing depreciation, suggesting that, for now, revenue generation is keeping up with Capex even as costs for memory, power, and cooling grind higher. Against that, the risk side of the AI narrative is becoming harder to ignore. Central bankers and regulators are flagging potential bubble dynamics, as AI spending is increasingly financed with debt, including through opaque private credit structures and leveraged exchange-traded products, while equity valuations embed earnings growth closer to 26% versus historic norms near 6 or 7. Policy and geopolitics are adding another layer of complexity, with U.S. export controls accelerating Chinese and European efforts to build their own models and cheaper open-source systems from China already drawing some global enterprise customers. Putting this together, AI still looks like a long-duration growth engine, but one that now carries visible risks around financing, concentration, and regulation. Watch next for hyperscaler Capex guidance, the pace of Korea's build-out, and any tightening in credit spreads, because national AI strategies are increasingly colliding with security-driven geopolitics, which brings us to the broader risk backdrop. Geopolitics today is still dominated by the Middle East energy complex, even though headline oil prices look relatively calm. The United States and Iran have agreed to pause attacks ahead of talks in Doha, helping Brent hold below the low 70s and WTI hover just above $70 after an initial spike on renewed violence faded. Beneath that surface stability, the Strait of Hormuz remains a structural shock point. Shipping transits have dropped from a pre-war average of about 135 vessels a day to roughly 70. While discussions about new management arrangements and potential Iranian tolls of up to $25 per barrel keep the prospect of a sudden cost shock alive. Global oil inventories have already been heavily drawn down, and Russia is considering a full ban on diesel exports after refinery outages, which would further tighten refined product supply. That combination leaves inflation more exposed to any renewed disruptions or fees in key choke points, with recent oil volatility and past shocks still feeding through to inflation expectations and wage dynamics. One implication flagged by multi-asset strategists is that a geopolitically driven inflation shock could hit both bonds and equities at the same time, undermining the traditional diversification benefits of a 60-40 portfolio. Equity markets appear largely focused on AI-driven growth, while bond markets are more directly pricing persistent inflation and geopolitical risk through higher long-term yields. Meanwhile, defense and energy security spending is rising, from Europe's shift toward more numerous, tech-heavy warships to strong demand for advanced missiles and aerospace backlogs, such as Honeywell's $19 billion order book. The key watch points now are the Doha talks, any announcement of transit fees or new restrictions out of Hormuz, and Russia's fuel export decisions, because a meaningful escalation would collide with already tight inventories just as growth reaccelerates, setting the stage for the macro environment we see in the real economy. The third pillar of today's story is growth, which continues to surprise on the upside, even as rates remain elevated. In the United States, recent data point to real GDP running around 3 to 3.5%, with last quarter's earnings growth above 20%, and several banks lifting their year-end S&P targets on the back of AI-driven and broader corporate strength. Labor market indicators remain firm, with low weekly jobless claims, wage growth in the 4 to 5% range, and personal income and retail sales beating expectations. The upcoming non-farm payrolls report is a key risk event, with consensus looking for around 115,000 jobs. Another triple-digit print would reinforce the picture of steady, above break-even hiring, supporting resilient consumer spending. Corporate Capex momentum is also strong and increasingly broad-based. AI-related investment is surging, but traditional sectors are participating too, from small-cap industrials reporting 20 to 30% earnings growth to aerospace names like Honeywell prioritizing factory and supply chain investment to unlock a $19 billion backlog, and telecom players such as BT and Verizon reshaping international operations to refocus on higher growth segments. This mix of robust nominal growth and above-target inflation tends to create opposing forces across asset classes. On one hand, strong earnings and positive surprises in sectors beyond megacap tech provide a tailwind for equities and help justify discussions of higher index levels. On the other, sustained growth and new spending commitments, including AI and defense, keep pressure on duration and support expectations for additional rate hikes from central banks, such as the Federal Reserve and the European Central Bank. Countering the upbeat growth narrative are concerns that AI-driven equity gains and earnings projections could prove too optimistic, especially for frontier tech names facing lofty valuations, rising financing costs, and competition from cheaper Chinese models. For now, the base case remains one of solid growth with pockets of AI and Capex-led outperformance, but with higher volatility and less reliable hedging, making the upcoming payrolls data, central bank commentary on AI and productivity, and the execution of large-scale projects in Korea and elsewhere crucial signals for how durable this expansion will be. To wrap up, the AI Capex wave, led by Korea's massive memory and data center build-out, still anchors the equity growth story, but rising leverage, concentration, and policy frictions mean the risk profile is no longer one-directional. Geopolitical tensions around the Strait of Hormuz and Russian fuel exports keep an inflation shock on the table, even with oil prices subdued, while strong U.S. growth, resilient consumers, and broadening earnings support risk appetite, but also sustain pressure on long-dated yields and traditional hedges. The interplay between these forces will shape how equities, credit, and rates reprice from here. So watching Capex guidance, geopolitical headlines, and incoming labor data together remains critical. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.